I am David Stein of Money for the Rest of Us, and in this video I explain the concept of paradox of thrift, or why everyone can't save 50% of their income. Savings. Savings means to save or take a percentage of our income and set it aside to spend later. The primary measure of savings in the US and other countries, at least at a personal level, is called the personal savings rate. And they're measuring the percentage of after-tax income, after-tax disposable income, so income you have after paying taxes, what percentage of that is saved? In the US right now, in 2019, it's about 8%. Back before the great financial crisis, it got to be less than 3%, an all-time low. So that's personal savings. Businesses also save. Business savings is the same as their profit. Their profit is the percent of their income that they didn't spend. So that's another aspect of savings. Now, if we combine personal savings, business savings, and government savings, that's something called the gross national savings rate. So what is the paradox of thrift? Well, we have to recognize that every dollar saved is saved out of someone's income. But that income comes from some dollar that someone spent. So every dollar spent is someone else's income, and it's out of that income that we get savings. And that's why there's a paradox of thrift, because as individuals or businesses, if they try to save more, let's say 50% of their income, that means they're going to be spending less, which means some other entity is going to have less income. Example, if you're saving for a computer, maybe you save $100 a month and you decide not to go out to eat as much. That means the wait staff at that restaurant won't be making as much, and it'll be more difficult for them to save. And so that's what Keynes means by the paradox of thrift. If everyone tries to save more and more of their income, that means they're spending less, which means other entities will have less income, and across the entire economy, demand will drop, and it will be much more difficult for businesses and households to save. Now, what actually happens in the economy, and most economies, is in order for businesses and households to save more, they need more income. And the way that they can get more income, if there's some other entity that's not a business or a household that is spending money. And often that's the federal government. When the federal government is running a deficit, which means they're spending more than they're taking in tax revenue, that money, that income flows out into the economy and makes it easier for households and businesses to save. So oftentimes when there's a higher savings rate, it also happens to be when there's a higher budget deficit. The other way that households and businesses can save, and you see this in countries that have a very high savings rate, is if the country is running a trade surplus. If the businesses in the country are selling more goods overseas, they're doing more exports than they're bringing in imports, that means there's additional income flowing into the economy, making it easier for those businesses to have higher profits, and thus the overall savings rate in the economy grows. At the same time, those businesses might be given raises to their employees who are able to save more. So those countries that run a trade surplus tend to have higher savings rates because they have more income. That then is the paradox of thrift. We might want to save a bunch ourselves, but if everyone decides to save, it can be more difficult unless there's some entity that doesn't want to save hardly at all, such as the federal government or other countries, businesses in other countries buying a country's goods or services. Hey, if you have any question on this video, you can leave those in the comments, and please subscribe to my channel. Thanks.